Welcome to the fourth Vontobel Fixed Income Day. As you have seen today, achieving good returns on the bond market, it's difficult. It's a challenge. The bar is higher. That is why we have used this metaphor of high jumps. It takes determination, it takes strength, it takes training, but more than else, it takes flexibility. That is the reason why today's meeting is the flexible income. Today, we'll hear about flexible investing in Vontobel, and we will hear from Hervé Hanoun, Head of Fixed Income, and also we will hear from Chris Bowie, who is a partner and a portfolio manager at 24, and he will talk about absolute return credit. We'll have time for questions at the end of the presentation. I'd like to hand it over to Francesco Carabine Castellani, Head of Global Fixed Income for Vontobel. Thank you.
Thank you very much, Matteo, and good morning to all of you. World investors are suffering. They're suffering because their main sure source of income, i.e. the fixed income, is running short has been running short for the last 4 or 5 years. We know that sovereign bond rates are very close to zero. Over the last few months, they are starting being afraid. They're afraid that the alleged American recovery, and of course I should have posted a picture of the new American president, but we've seen him so frequently that I decided not to have it. So this is generating inflation, and meaning increase or hikes in the interest rates and losses in capital. So when you have pain and you also have fear, of course, you might end up with panic, and therefore the behaviors of even institutional investors may take very different directions, and these directions are very often not linked or due to rational thinking. Such a behavior could have been foreseen after 30 years of bull run in the fixed income. So this is the backdrop Vontobel has been working with over the last 7 or 8 years. And we have created one of the best world team in what we define as the flexible fixed income, flexible investing. Some time ago, I met an incredible person from Australia, an entrepreneur who had gone through a number of bankruptcies, but he had made a lot of money. He was also a pilot, and one day his airplane had crashed, and he was totally paralyzed. The doctors told him, "You're going to spend the rest of your life in bed." But he was so strong-minded, and he, little by little, started recovering, moving one finger after the other. So he took a lot of patience, he never gave up, and finally he made it back, and he was able to start walking again. This guy told me, "You know, Francesco, I have to exercise every day a little bit. Unless I exercise every day, I will lose my flexibility." So that was a physical recipe that we can translate into our own investment philosophy. We have to be constantly flexible in moving and allocating our portfolios. How did we translate this into practice? We have 2 main boutiques in Vontobel, managing 25 billion with some 40 professionals. In Zurich, when we started managing fixed income back in '88 with the rates and interest rates, we created 5 years ago a very strong credit team. This is an asset class where investors poured in. The credit has increased tenfold in the last 7, 8 years. So we started investing in emerging markets, and we also hired a flexible team, and I'll introduce it very soon. It has one of the best world track error in a track record in this approach. And then we also invested in another company that was set up in 2008, specialized in decorrelated investments, one of the best team in asset-backed security. It's an unconstrained fixed income manager, a pioneer in what Chris Bauer described as excess return credit. Absolute return credit. Chris has an incredible track record. He matched his experience in ego rates experience, and also who used to be also a manager for the high yield fund. So he has experience both in sovereign bonds and in credit funds. So he created this absolute return credit fund for 24. He'll be speaking about it. And since the inception, he became immediately very successful with almost $500 million assets under management. Then we will have Mr. Herné Arnaud, in order to really complement our Zurich boutique. So we looked for the best world track record, i.e. Amundi. Hervé spent 15 years for Crédit Agricole under different hats. And then in 2008, he created the Bond Global Aggregate Strategy. That's what they call it. This is a strategy that is highly appreciated by some of the best world investors. It's a very unique strategy. The high diversification in all asset class, including currencies. The main objective is that of reducing the total portfolio risk. Hervé moved to Vontobel 3 years ago, and we launched a fund with the same name, Bond Global Aggregator, which is our flag strategy. Flagship strategy. Well, some people say that if your leg hurts, you can cut it out, but then you won't be able to walk. And the same applies to investment. If you take out and branch out a non-performing fund, you won't be able to make money. Our strategy is to really manage it in a flexible way, and this is going to be the winning strategy for the future. With this, I'll give the floor to Herné. Please, Hervé, the floor to you.
Thank you, Francesco. So first of all, good morning, and thank you very much for being here. As Francesco said, I am Hervé Hanoun, the head of fixed income at the Zurich-based fixed income team in Zurich. And to start, obviously, what is very interesting is about the title. The title of the conference today is Flexible. And what I'm going to do today is define the way we see flexible. Why? Because just flexible means, I would say, everything and nothing when we talk about fixed income, because it's a quite new word, actually, quite new font. A lot of what new flexible strategy you see on the market are less than 5 years old, which is, I would say, also not the case for us. But flexible strategies makes a lot of sense for many reasons, and I'm going to explain why. First of all, we have clearly a dilemma today on the fixed income market. As you are all aware, we had Trump, we are, as we will see a bit later, in a rising yield environment. And what you can observe on this graph is just that now the performance of the fixed income market, represented here by the global aggregate benchmark, is turning more negative. So it's very hard after many years of positive performance coming from the bond market. You have much less carry due to the very low yield, and obviously negative return due to the rising yield environment. What you observe as well is definitely that a lot coming from the global bond index, you see that most of the bonds has also a very low return, which creates, I will say, a very complicated situation for investor in general and fixed income investor in particular. Because you get, I will say, a dilemma. How to get performance, how to get diversification, and how to get income coming from the fixed income market. And here, on one side, you have the traditional fixed income way, and what we are going to show you today, the way our solution and the way we interpret flexible fixed income. So the traditional way is quite simple, I would say. If you need to get more performance and more income, the only way to do it is clearly to go down the yield and the risk profile. That means that you take more and more risk by moving from, I would say, traditional global bond market, government bonds, to investment grade when it's not enough high yield, after emerging hard currency, or USL yield, and even you can talk about loans and everything. But you can have, I will say, another way. And it's exactly what I'm going to show you. We're going to show you the way we do it by different factors. The first one is broad investment universe, ultimate diversification, how to get the optimal team setup, what is an active risk management, and how do you manage in terms of risk. The fifth factor is the importance of convexity and liquidity, and the fact that we don't have any bias. But let's start with the first factor, which is the broad investment universe. Because when we talk about fixed income market, actually, we talk about very different markets, because you cannot compare high yield with emerging market local currency, with investment grade, inflation-linked bonds, government bonds in the US, government bonds, I will say, in Brazil, and also, as I will show you, currency. So you have different factors and different, I would say, segments inside the fixed income, which behave, as you can see here, for instance, on the US high yield, very differently depending on the market cycle. So you see, for instance, on the high yield, you have one factor which is very well performing in 2013 and 2016, and almost the worst performer in 2014 and 2015. So the first fact, an important fact, by flexibility, is obviously to be able to go to tap the value, to go where you see the value on the market and on the fixed income market as the value change over time. And that's, I will say, a very important factor. So the first important thing of your fund is to be able to get to tap this value, which is very important. The second factor also, which is very, very important, is on the diversification. So here it could be quite complicated, but it shows that on the markets, you have very different correlations which can change over time. As you can see here, for instance, the correlation between the US dollar and the yield, US 10 years yield, is totally changing over time. So by analyzing the correlations, you can have also create some performance. But what is important is there are two factors to create performance on the fund. The first factor is clearly the views, so the views you have on the market. But the second factor, which is very important, is the portfolio construction. And the portfolio construction is illustrated by this chart. It shows that how you assemble all your position together, how you take into account all the position, the relationship between all these positions, because you can have, for instance, a long position on rates, but it can be hedged or increased performance by a position in currencies or in credit. So that means that you should not take a position on a standalone basis. And what is important in portfolio construction, how you build all this position inside your portfolio, is that it creates performance, and actually a much stable performance than the views. Because on the views, when you see an average manager or a fund manager, is right around 52 to 55% of the time. Let's say 52 on average. That means that half of these decisions are wrong. That means that you need to complement the views with a very strong portfolio construction to enable your performance to be much more stable over time, which is very important. and also to take into account, as I said, the change of correlation. The third factor, which is also very important, is the team setup. What we have done at Vontobel is to have created what I think is the optimal team setup to manage, I would say, global, diversified portfolio, which can invest, as I said, in the whole universe inside the fixed income. So all these people, so all the fixed income team is seated together. That means that we have very strong interaction. We have a cross-pollination of ideas between all the fund managers. And as you can see here, you have credit people, high yield people, emerging people, you have convertible people, and we don't separate all the segments of the fixed income. That means that all these people are communicating very well, and also the philosophy we have at Vontobel, in each area, we took the best fund managers. For instance, when you have Luc Doug, which is one of the best hard currency emerging fund manager, Monder Betayeb, we just hired Sergei Goncharov from Russia to analyze all the emerging corporate markets. We have Anna Olsgang, which is a very strong fund manager on global fixed income. So really, we have all the expertise around the desk. That means that we can communicate, and being here and able to invest in all this area, I am able to get the information in real time and very quickly, and if it makes sense in my portfolio, I can invest directly. So it's a very efficient process. So let's go a little bit more now in the detail of the funds and how we do invest and what we talk about diversification. So as I said earlier, traditional fixed income is really based on government bond, mainly investment grade, and on the global aggregate, some securitized product. But most of the risk and most of the volatility of your portfolio comes from duration, a little bit of the curve, and a little bit from credit. So you are totally exposed on the move of interest rates. What we do is something totally different. As you can see, first of all, and as I explained earlier, we have extended quite a lot the universe by having on top corporate, high yield, and global, so US, emerging, and European. Currencies, which is an asset class, so we do consider that currency is a very important asset class, for different reasons, for obviously to get performance, but also to stabilize the performance and the volatility of the portfolio. It's a very liquid asset class, and a lot of position you want to experience can only be expressed through currency, and I will show you that a little bit later. But what is very important and what you can observe is now that the table here is very different from what it used to be. So from a very, I would say, duration-based portfolio, you have a very different approach because, first of all, your risk is very split between rates, credit, emerging markets, and currencies, but also that the risk can move. That means that if I don't see any opportunities, let's say, on currencies, it will not be 30%. It can be 0 or 5%. So it can be very, very flexible in your allocation. But also, you extend the level of diversification because here, obviously, you have very low diversification because most of your diversification and your risk is in duration. Here, you have much more level of diversification. The first level is through the different asset classes, so rates, credit, emerging markets, and currencies. But what you can observe is a second level, which is here. So directional position, and I will give you an example a bit later, and relative value. So you have different type of strategy of decorrelated position between very directional position and this relative value. And the third level of diversification is a diversification by horizon, which means that it's a diversification by having a core or long-term macro strategic position, which have an horizon, an investment horizon of 6 months to 1 year, and a tactical approach, which is more short-term and which allows you to manage actively the total volatility of your portfolio and to avoid to have big drawdown inside your portfolio. So you can see that you have a very, very different approach. And when I was talking about diversification and decorrelation, it's exactly what you can observe at the different level on that page. So let's illustrate what I've just said in terms, for instance, directional strategies. So for instance, on the directional strategies, you've got here, purely, for instance, if we took the credit, for instance, like one way, are you long or are you short credit? In that case, it's going to be, for instance, you see that it has performed very well recently and over time. That means that by being long, you create performance. But sometimes you don't have any view on the pure directional. So let's say, okay, I don't know where the credit is going to go. However, I have a very strong view of the spread of, in that case, European credit and US credit. So in that case, you will say, okay, the credit will, I really believe, I don't like, in that case, the US credit and I like the European credit. It will, most of your performance will be done through the difference of spread between the two. As you can see here, by being long US credit, you will have massively outperformed the European credit, even if you don't have a clear view on the credit asset class per se. And the second thing I wanted to illustrate is the short-term and tactical risk management, which is, I would say, essential in a flexible strategy. It's essential for many reasons. It's essential, for instance, to be able to take opportunities, so short-term, what I call short-term trading, to capture short-term opportunities, which means that maybe you have a strategic view, like as I said, 6 months to 1 year view, but you can see like you can have like, because of a mispricing or repricing, a big opportunity on a 1 week horizon. And you want to be able to take this opportunity on the 1 week horizon just because there was maybe a speech or a central bank who did something, and you see that it's totally mispriced, so it gives you like an opportunity to enter. But the second factors and the third factors are also very important, is the dynamic hedging. The dynamic hedging is just to say that what we want in the portfolio is to have a maximum volatility of 5%, which means that our funds, our flagship funds, Vontobel Global Aggregate, has a volatility which is actually less than 10-year notes. So 5% of volatility. But this 5% volatility is managed. What do I mean by that? By managed, I mean that it varies over time. Sometimes it's going to be very close to the limit, to the 5%, but sometimes it's going to be because maybe there are less opportunities, or maybe we think that our strategic position will work a bit less, and we want to re-engage the risk later. So we will have a dynamic approach of the total risk of the portfolio. And the last part of the tactical management is clearly the what we call the tail risk management. Is in an event of, I would say, big stress on the market, or where you have a very strong recorrelation of assets, which is quite also dangerous for all the fund managers, you are quite well protected. And we do that through, for instance, the use of different options, because we use options like I will show you. So, last part, fifth part, on that is also, when I was talking about options, is to show you on currency. What the importance of currency is very well illustrated by this position. So first of all, when I was saying that you can express views through the currency, for instance, here we play the Chinese slowdown and the depreciation of China through dollar Korea options. But what you can observe on this graph is the very asymmetric profile of this position. That means that when you lose, actually, you have a very limited downside on your position. However, when you're right, and if you have this depreciation, you will have a very convex and exponential return profile. And it's exactly what you want to obtain, to really have a strong control of your downside risk and have more or less very high profit profile. And what is also very important in terms of liquidity and diversification is the fact that by using currencies, you add a lot of liquidity inside your portfolio. And liquidity is a key aspect because you get less and less liquidity on the market, and particularly in terms of stress, where it's impossible to get out of positions. By having also around 25% of our positions, of our risk in currencies, allows us to have this strong flexibility and the strong liquidity inside our portfolio, which is very important. So if we go a little bit more in details into the funds, what we can observe is on the left side, the guidelines, simply. And on the right side, what you can observe is the risk allocation of the portfolio. So what you see here is that the risk and the position is very well spread between rates, credit, emerging markets, and currencies. Why it's important to have that it is well spread and well diversified? Because if you start to have, let's say, the blue bar here counting for all of your risk and all your position, you will destroy your diversification effect. You will, when I was talking about the views on one side and the portfolio construction, you will put all the stress and emphasis only on the views. That means that if you're right, you will make a lot of money, but if you're wrong, you will lose a lot of money. And that's something we want to avoid. What we want is to be sure that we have a balanced allocation inside our portfolio. And that's very important. And as you can see, it varies over time depending on the opportunities, and each bar varies depending also on the opportunities. And here, what you can see on the guidelines is, as we said, we target 5% per annum over a cycle, which is usually 2 to 3 years, with less than 5% volatility. We put a reference benchmark, but the approach is totally flexible, totally on an absolute return approach. The duration can be managed also with a strong flexibility, as if we have a negative view, we can go to zero on duration and put our risk and our positions where we see more value. And in terms of investment universe, as you can see, to be sure that we are very well diversified, we put these limits, for instance, 25% on corporate high yield, 40% on emerging market, 20% on investment grade ABS, and 15% on convertible. This is important to keep and to be sure that the fund is very well diversified and continue to be very well diversified. Obviously, to do that, you need quite advanced tools to be sure that, and to really understand, I will say, how the positions are split, and to be sure that you have a consistent allocation of volatility inside your portfolio. And it's exactly, you can see here, at the portfolio level, when you have a strong control of the volatility of the portfolio, at the rate level, credit level, and currency level, taking into account that all of that has decorrelation. So you see here that you have not one big position going more than 1.5% of volatility, which is very important. So what is the output of all of that? first thing is output is since the creation of the fund at Vontobel, I've been managing this strategy, as Francesco said, for more than 15 years. Which has delivered strong performance and risk-adjusted performance in any type of market condition, which is very important. So it's a strategy which is delivering on the long term very strong performances with this process. What is also very important is that the performances, as I said, as we saw the different positions, is coming from different factors. So sometimes the performance is going to come from the duration, sometimes it's going to come from the emerging market, sometimes it's going to come from the currencies, from the periphery, from credit, from high yield. So you have very diverse sources of performances inside the fund, which is also what you want to obtain, and which is very consistent in all your fund. Very important point as well, and it's exactly what you want to obtain, is obviously, as it's a pure, flexible approach, you don't want to be correlated to any type of asset class, particularly on the long run. And what you observe here in the funds is, so when you see high correlation is 1, negatively correlated is -1. So when you are close, when you are at this size, that means that you have very little correlation, so it creates a lot of decorrelation in the fund. And what you observe here is the fund Vontobel Bond Global Aggregate has a very low correlation with any type of asset classes, from high yield, Euro corporate, rates, government bonds, US Treasury, Euro aggregate, and stocks, and so on. You see that the correlation here is one of the lowest you can observe on the markets, which is very important. And you see it very clearly here, as you have, for instance, the performance of the global aggregate and the performance of the fund, and you see that a lot of periods are fully decorrelated. One is going up, the other one is going down. For instance, here, when it goes up, it's just because it's more not because of the position you have in the benchmark, but much more of position because you don't have in the benchmark, like currencies, for instance. Well, so that's my first part, I will say, of the presentation, in the sense that what I wanted to show you now was the way we see flexible bond and the way we invest in flexible bond on the fund global aggregate, which is, as I said, very diversified funds. But right now, I'm going to go more in market views as well. What are the positioning of the fund and what are the current themes we have inside the portfolio? Obviously, we are at a very interesting time. Donald Trump just took office in the US. Some people think it's a game changer, some not. Let's see what are the consequences of that, but we clearly think it's a big game changer on the market and for asset classes. And we split our views in 3 different themes. So first one is interest rate set to rise in the first part of 2017. That means that duration is a risk. Theme 2 is that you still have some value in the spreads, which has a different spread, and I will show you where we think there is some value. But also what is very important is 2017 can be, obviously, a very volatile year for different factors, and I will explain why. So the first thing is just to say, it's very simple, actually. Let's not talk about Trump first. Let's talk about what we observe today on the global economy, and particularly on the US economy. What we observe today is, as you can see on the current activity indicators, but we can observe that through different, from surveys to hard data, we have a very healthy global economy. The current activity indicators, as you can see here, is going up. You see the fundamentals improving as well in Europe. US is also doing very well. So the first thing we have to say is like, does the economy need today a stimulus? And the answer is clearly no. So the first thing on Trump is what he will do. He will put a very strong stimulus, fiscal stimulus. He will do a lot of spending as well, infrastructure spending, on an economy which is already, as you can see here, more or less at full employment, and where you can observe some inflation coming higher and higher. And on top of that, in the US, headlines and core inflation is going up. You can observe here from jobless claim as a percentage of private payroll, which is a very good indicator. We are more or less at the lowest in history. Here, what you observe from unit labor cost, which is an advanced indicator if you advance 1 quarter compared to the core CPI, what you observe here is that you've got a massive rise of inflation in the US. So what's going to happen is Trump stimulus, and what we observe from his first week of mandate is more or less that so far he has delivered what he said, which means that on the economic front, we can expect to have massive tax cut, infrastructure spending. So it's going to be very positive for, I will say, some risky assets. It will be very, very negative on the rates, but it will have a very big impact. And the risk today is that, first of all, the market is not pricing that too much already. The fact that by having only 2.5 rate hikes priced in 2017 is quite, I would say, conservative, and that the Fed, which is focusing on two main factors, as you may know, which are labor, unemployment, and inflation, as you can see on these two graphs, is already at quite very low level on both on side and high level on inflation. That means that they will have to act. And if you start to have more inflation, that we have to, I would say, even overreact. That means that you can have a very much more aggressive Fed. And when you see what is the rhetoric of the Fed, because here you have the dots. The dots is what the Fed members are expecting, the expectation of the FOMC. And you can see that they are quite low. But you see on the 18th of Jan, most of my colleagues see a few rate hikes this year. Gradual tightening may have to hike faster if fiscal policy shrinks slightly faster. I am a supporter of 3 hikes in 2017. So you have a lot of more and more hawkish. Everybody thinks that the Fed is dovish, but I think it's a big mistake. It's like the Fed was dovish over the last years because it has the possibility and it makes sense to really help the economy. Today, if they need to be hawkish, and particularly with Trump, they will have to show that they are not behind of the curve, and we can have like surprise. And actually, it's also the same. It's a very asymmetric profile. That means that the market only priced 2.5 hikes, as I said, but they will deliver, and they can deliver much more than that. Third factor, so obviously, is in Europe, the situation is slightly different. We can say clearly that things are improving. You can see here from the output gap, also from inflation. So things are improving in Europe. We saw it on the first slide I show you on the economic indicators and surprises, that Europe is doing also quite well. However, the situation in Europe is very different. First of all, you don't have any inflation. You have some headline inflation, but no core inflation. As you can see here, low nominal growth is hurting the debt ratio. But mainly, as you can see here, and actually I forgot, it's by year here. So here it's 2017, 2018, 16, 15. What you observe here is very important is that how do you get growth in Europe? Very simply, today you get growth by fiscal impulse. But how you do the fiscal impulse is by doing the QE. That means that today it's going to be very complicated for the ECB to get a growth without QE. So we expect we expect to have QE for quite a while actually, and it's exactly what Draghi did, because Draghi, by pushing back the QE until December, by switching to 60 billion a month until December, it was a very smart move for many reasons. It was a very smart move because, first of all, he bought time. After that, he can observe what's going to happen with Trump. Does Trump deliver, and what will be the impact on the global economy? He will have time to see what's going on the political front, because we have a lot of political events in Europe. And what he has done very smartly as well is to massively lower the expectation of the market. Today, nobody expects anything from Draghi. They know that we will have the QE until December, and maybe in the second part of 2017, if things are getting really well, and if you start to see very strong signs of inflation, particularly in Germany, maybe in the second half of the year, the market, not Draghi, will price and will anticipate maybe some type of tapering. But so that's something to consider, but not right now. Right now, I think the focus is clearly on the US and not in Europe. So how we position today? So we are short duration, logically, on the US, slightly long on the very short term on the Australian curve, and on the credit, European credit, we are long. So we have really this relative value US against Europe inside the portfolio, with a small flattening positions in Europe, and as I will speak in 2 seconds, long peripherals, mainly Portugal, against bond. Second theme we have in the fund is that spreads are still attractive, but not any spreads. So the first thing where we see value is Portugal. Portugal is clearly, I would say, a bad story, but we think that when you have 5% of yield on Portugal with the support of the ECB and with strong improving fundamentals, strong, I think it's an extreme word, but improving fundamentals, we think that all the bad news are pricing into this 5%. So we think that there is value to have some carry on Portugal. The second aspect where we see value is on subordinated debt. So we have a very diversified approach on the carry, and we also have a very diversified approach on subordinated debt. I just put here on the, so we have, for instance, insurance lower tier 2, legacy tier 1, and also we have in the portfolio 5% of additional tier 1 on high quality names. Why? Because we think that, first of all, the fundamentals of the banking sectors in Europe is improving, that the buffer of all the bonds we have is very high, so there is very low risk that it is triggered, and at the same time you have a very attractive yield with a quite short-term maturity, so which is quite attractive for a portfolio to give a good carry and a good yield inside your portfolio. On the same theme, what is also where we start to see value is clearly on emerging markets, so hard currency, not local currency, but on the hard currency. So we have not a big position, but what we see is like for the same, compared to, I would say, developed market, you have much higher spread on emerging market for even higher quality papers. That means that you have, as you can see here, much less leverage on emerging corporates in that case, and you can observe that the spread is much, much higher. So in terms of risk-adjusted return, is quite efficient. It's exactly what you can observe, just a summary of our position here. So some name we have, so we are positive on the credit and relative value, so we are long additional tier 1 CoCos, Intesa, BBVA, BNP, HSBC, UBS, ABN Rabobank, just to give you an idea. Insurance tier 1, AXA, Allianz, Generali, CNP, La Mondiale, Nationwide, SCOR, Groupama, and Zurich, which are, for us, we like to take quite blue chip because to go down in the subordination, but take very high quality names. The same on emerging markets. Third theme is about the risk in 2017. Obviously, the first risk we can see is Trump on the trade war, because we still have a lot of unknown with him, and particularly about the trade war, what's going to happen with China, what's going to happen also with Mexico and with NAFTA. So even if we see that it can obviously create a lot of volatility. This is a very interesting graph which shows you what is the baseline scenario, I think it's Goldman Sachs, and what is the impact on inflation, GDP, unemployment, and fund rates if you start to have tariffs with or without retaliation with Donald Trump. And this risk 2, obviously, is a political risk. We have major event. We really think that Brexit is a big story. We think that there is a lot of unknown, and I think British people don't know anything about Brexit. We think that the negotiation with EU will be very, very tough, and it will create a lot of volatility, at least on the British economy, and particularly on the sterling. So we are quite short sterling at this level. You see also you have the election in France, in Germany, and obviously what's going to happen in Italy, or are we going to have like earlier general election. So we can expect a lot of volatility without forgetting, obviously, Holland, which is the first one on the 15th of March. And the third theme, which is very important to us, is obviously China. China is a big concern. We don't think that China is going to burst and to explode, but we think that, first of all, a lot of the growth done by China has been done through a lot of leverage, corporate leverage, household leverage, and so on. So it's not sustainable in the long term. But what worries us the most is the number of outflows you have in China. What you can see is like the reserve in China lost already 1 trillion. That we see more and more outflows in China. A lot of wealthy people want to leave the country and leave their assets. And the big adjustment factors for us in China is the currency. Because if they want to continue to have the capital control, we think that the currency will have to continue to depreciate massively in China. And that's exactly what we do. So just to finish on the way to explain it, to be short Asian currency like Korean won, Taiwanese dollar, Singapore dollar, Chinese dollar, short sterling, and short euro makes a lot of sense to play this trade, and particularly at this level. So it shows you as well how you use currency to implement macro themes, because to implement this theme through different assets is also very complicated. So it's also, you really extend your investment universe by also using the currency. Just to conclude, so what we showed you today is like clearly a flexible bond strategy, which is quite unique by having such, I would say, a large investment universe, such a strong decorrelation, strong diversification, a low correlation with any asset classes, and which can deliver strong performance over the investment cycle with a very disciplined and active approach on fixed income markets. Thank you very much.
Thanks. Thanks, Fabi. Thanks, Fabi. Good morning, everyone. I'm Chris Bowie. I'm a partner and portfolio manager at 24. Francesco introduced me earlier on. Today I'm talking about our absolute return credit fund, which we think has a key part to play in any flexible bond proposition. So firstly, I'll just outline who I am and who 24 are, and then I'll go on to talk about the fund specifically. So before, at 24, I was head of credit at Ignis for 10 years. In fact, I came to Milan many times in this hotel presenting on behalf of Ignis. Before that, I was head of rates at Aegon, as it was called then. It's now called Kames, of course. So I've been managing bonds for more than 2 decades across rates and credit. And in fact, one of the things I'm most proud of is in 2013, Citywire named me as having the best Sharpe ratio, or risk-adjusted returns, in global credit. And my whole philosophy is about risk-adjusted returns, so you will hear that phrase a lot through this presentation. 24 is a fixed income only boutique. We're based in London. We started literally the week before Lehman Brothers went bust in 2008, so it was a really challenging time to start an asset management business. But we have now an average experience on our partners of more than 25 years. We have getting on for 10 billion euros under management, so we're delighted with the asset growth we've had since 2008. And our asset growth is shown here. We started in ABS, asset-backed securities. In fact, our first client was the Bank of England. We ran down the Northern Rock portfolio when that bank went bust in 2008. And from that point, we then launched our unconstrained business. We have a multi-award-winning strategic bond fund. It's won Best Strategic Bond Fund many years in a row in the UK, and it has gathered a lot of assets. And then I joined 2 years ago to launch the investment grade side of the business, which we call outcome-driven. And as of today, we have around 900 million euros under management in a little over 2 years. The fund product range is shown here. We're split by business line, ABS, unconstrained, and then the business line I run is outcome-driven. I have 2 public funds. The one I'm talking about today is this low volatility credit strategy, the absolute return credit fund. One of the things that's very different about 24 is our approach to liquidity. Liquidity is a very interesting thing in fixed income. It can be very good and it can be very bad. And in very recent years, it has often been very bad. So at 24, we make a big distinction between the funds in these light green boxes. These are daily priced, open-ended funds. And because they need liquidity, they have heavy restrictions on what they're allowed to invest in. We think there are lots of great opportunities in less liquid credit, but you cannot own them in daily priced funds. Instead, we own them in our closed-ended funds. These are investment trusts in the dark green boxes. But the fund I'm talking about today is certainly at the upper end of what we consider liquidity to be. It's my most liquid fund. The team, all of these people here are portfolio managers. In fact, 10% of our portfolio managers are Italian, in fact, so we have a very strong link with Italy. My team on the right-hand side here, but I would just highlight 2 other individuals here because they represent a change we're making at 24. Right in the middle here, Robert Arnold is an American national who we hired in 2016. He's based in New York for us. And actually joining him in the next couple of weeks is Pierre. Pierre's been with us for a number of years in London. In February, he will move out to New York full-time because we think over the next few years, the dollar market from high yield and from investment grade will be the most interesting market. Sovereign yields are rising and credit spreads are very, very attractive in the dollar market. So we're actually investing heavily in the US. Okay, moving on to the fund specifically. If we start with the problem as we see it with fixed income, we know that delivering an income for your clients is becoming harder and harder. And this really is the problem. If we look at the investable universe of tradable bonds, this is the Barclays Multiverse Index. You can see it's a huge index, almost $50 trillion of bond exposure here, many thousands of bonds, more than 21,000 bonds in that index. It includes global investment grade credit, global high yield credit, and global sovereign bonds. So you can see the average quality is very high, AA-. But the problem with this as we see it is the relationship between yield and duration. Look at the yield, it's only 1.89%, and the duration is about 4 times higher than that. And that presents a very risky proposition to us, because if yields rise modestly over the next few years, with that kind of portfolio, you would have significant capital losses. So wherever possible at 24, we try and have portfolios where the yield is higher than the duration. And that's certainly the case with my absolute return fund. Its yield is 3.2, its duration is 3. We think that's the best possible way of giving you a good income for your clients, but also protecting capital in a rising rate environment. So when we look at this, we wondered if one way of navigating these problems is to look at the absolute return sector. The trouble with that sector is it's a very complex sector, very expensive quite often, very complicated funds, and the performance track record has not been that good. Many funds have had negative returns in this sector. So we wondered if it's possible to have an absolute return fund that is run quite differently. So this is the term sheet for my fund. What's different about it is it's long only. And we have a sensible return target of Euribor plus 2.5% after fees. But we also have another important goal, and that's to keep volatility low and always below 3%. Now, the trouble with an absolute return fund is, if it's long only, how do you protect the downside in the worst years for fixed income? And this is where we spent a long time working out the best areas of credit that will give you consistently good returns with low volatility and also very low drawdowns. But we've designed this fund to be very easy to understand. So it's long only. That means there's no leverage in it. There's no performance fees. Very easy to understand. And the core part of the fund, most of the fund, is always invested in short-dated investment-grade bonds because they give you consistently good returns with very low volatility. But we can do more through asset allocation and through stock selection to improve returns and actually lower volatility. But this is certainly not a black box. It's just using our investment process to its fullest. And the consequence of all of this is we think this fund has great potential to offer you very good returns with very low volatility and low drawdowns. So how has it performed since launch? Well, we launched at the end of August 2015. And you can see here the green line is the fund NAV, and the dotted lines are LIBOR and LIBOR plus 2.5% respectively, which is the official performance target of the fund. So you can see we've consistently outperformed that. And if you look in the legend of the graph, it might be hard to see from the back. But we've achieved a return of 5.7% with a standard deviation of only 1.5%. Given what's happened in the last 18 months, we think that's an exceptional return. That's given us a Sharpe ratio, or a risk-adjusted return, of 3.28. So we're delighted with returns. How have we achieved that, and why did we pick short-dated bonds as the core part of this portfolio? Well, to start with, our idea was we want to have a fund that has steady and repeatable and consistently good returns. But we didn't actually know the best way of achieving that. So what I did was created a research project where we downloaded 204 different credit indices. This is, in fact, all of the investment-grade iBoxx indices in Europe, in euros and in investment-grade sterling, and created a back test using daily data going back 15 years. And what we found was, if you plot the risk versus return of these 204 indices, this is what you end up with. So not surprisingly, as risk goes up, return tends to go up as well. There is a relationship here, there's a linear relationship between risk and return, as you would expect. But 2 points really stood out for me. This BQT6 and 7A0E both seem to generate much more return per unit of risk than all of the other credit indices. So naturally you ask, well, what are they? Well, BQT6 is the overall sterling BBB index, and 7A0E is the overall Euro BBB index. So our first observation was, going back 15 years, including years like 2008, BBB investment-grade bonds compensate investors very well for default risk. They consistently produce above-average returns, even accounting for the occasional default you see in BBBs. The reason sterling BBBs are more volatile is because it's a longer-dated yield curve. You see companies in the UK, for example, issue debt out to 30 years, even 50 years sometimes, whereas in euros, most companies borrow for 10 years or less. And that duration difference really explains the volatility. But we took it one stage further. Given that we wanted to have a fund that had very low volatility, we wondered, well, let's just look at the credit indices that have less than 4% volatility. Because if we mix them together, perhaps we can come up with a combination of these that gives a very good risk-return combination. So in fact, you can see that on the next page. We solved for 3 specific questions. If we mix all of these indices together, what's the best possible combination that gives us the lowest risk? What gives us the highest return? And which gives us the best risk-adjusted returns, or the best Sharpe ratio? So if we start with the lowest risk portfolio, this is shown on this efficient frontier here, and the lowest risk portfolio is right there. This is a portfolio that generated just under 4% returns over that 15-year period, with a standard deviation of less than 1%. And in fact, the portfolio was all short-dated. So not surprisingly, the least volatility comes from the shortest dated bonds. In this case, it was all 1 to 3 year bonds. If we look at the other end of the efficient frontier, right at the top here, this was the highest returning portfolio. So it had a much higher return. It also had much higher risk, though. And in fact, 99% of this portfolio was in Euro BBBs. However, the one we were most interested in is this optimal portfolio, which is here. It's called optimal because it had the best Sharpe ratio, a Sharpe ratio of more than 4.5, in fact. Very attractive return, 5.1% annualized return, and a standard deviation that's essentially 1.02. But what was very interesting to us was look at the proportion this fund had in short-dated bonds. It was 67.5%. That number is very interesting because it's very close to 2/3. And as we'll go on to see, the fund mandate is that we must have 2/3 in short-dated investment-grade bonds. And it's because over the last 15 years, a portfolio like that would have given you the very best Sharpe ratios. So that tells you what's happened over the 15-year period, but it doesn't show you what day-to-day volatility would be like in that kind of portfolio. So in the next slide, we can see that. The green line here shows you the NAV you would have had if you had had a passive portfolio that had 67.5% in short-dated investment-grade bonds. The red lines show you the volatility that's associated with that. Now, it uses the right-hand axis scale here for the red lines. And as you can see, even through a year like 2008, the long-term measure of volatility never went higher than 2%. And if we look at the pink line, it's a bit hard to see on the screen, even the short-term measure of volatility never went higher than 3%. So immediately we knew if we have an absolute return fund that's long only, and most of that fund is in short-dated bonds, we can have an attractive return, and we can keep volatility below 3% at all times, even in the worst year for fixed income there has been in 100 years. And then when we took it one stage further to look at the drawdowns, we were amazed how low they were and how infrequent they were. So the drawdowns you can see here. Yes, occasionally, even short-dated bonds do lose money, but it tends to be for a very short period, and it tends to be very quickly reversed. So in 2008, for example, the worst loss was 175 basis points. The total loss period was only 98 days. So in fact, over the calendar year 2008, there was a positive return. Same again in 2011 with the sovereign crisis. The worst loss was 173 basis points. Total loss period was only 118 days. And over the calendar year 2011, you had a positive return. So in fact, each of these years had a positive return, and that's why we call the fund absolute return, because this kind of strategy has always made you money every calendar year up to this point. So that was interesting in itself. Bear in mind this is a passive portfolio. But when we compare it to a broader measure of credit, we were amazed at the difference, because the green line, as before, shows you the NAV from the short-dated fund. The blue line here is the iBoxx All Maturity Index. And you can see, yes, the return's not as high, but you've actually achieved 81% of the return. You've got a 5% annualized return versus 6.3. But the crucial difference is the drawdown profile. If you look at the drawdown profile of the blue line, through 2008-9, losses got to almost minus 20%. And in fact, there was an 842-day loss period. Contrast that with the short-dated portfolio, which remember is giving you 81% of the return, but the maximum losses were here. And those losses were reversed within 98 days. So we instantly knew a short-dated portfolio would achieve what we wanted within the absolute return sector. It would give us positive returns every year, very low volatility, and very low drawdowns. Ultimately, what we found is short-dated bonds are so good because they get pulled to par every day, and that pull to par nature will trump capital losses over any reasonable time frame. So this is all passive. If we now go on to look at what we can do with the fund actively, you can see we can actually improve things even more. So on the right-hand side here, you can see what the fund mandate allows us to invest in. In the middle, what we call the core, this is the most important part. We have to have at least 2/3 of the portfolio in this core. To be core, bonds have to be both investment grade and they have to have less than 5 years to maturity. Around the outside of the portfolio, we can do some other things to enhance returns and also lower volatility from time to time. So if we take them in turn, longer dated investment grade, that doesn't mean buying 30-year bonds because my objective is to keep volatility below 3%. So I buy some slightly longer dated than 5-year bonds, like 6-year bonds, 7-year bonds, and even some 8-year bonds. Because credit curves are very, very steep, it's right to take a little bit more duration risk, but not too much. We don't like anything beyond 8 years to maturity because the duration impact is then too severe. And since launch, we've had around 15% of the fund in longer dated investment grade bonds. If we move around to high yield, we're very, very specific here. We're only allowed to buy BB rated high yield bonds. So BB rated bonds are the highest rating category within the high yield space. We're not allowed to buy single Bs, double Cs, triple Cs, for example, because they would simply be too volatile for this kind of fund. In terms of ABS, ABS has had a bad name through the crisis, but they were all US-style ABS securitizations. At 24, we only do European. And in fact, European credit losses from ABS were tiny, in a handful of basis points across the whole sector. So European ABS is a completely different thing to US ABS, which was part of the subprime crisis. In fact, we've had zero in ABS since launch, but because rates in the US are now starting to rise, and we think they'll rise 2 or 3 more times this year, we're getting closer to the point where having some floating rate bonds in the portfolio will be a very good idea. So I think in the next few months, I'll start putting 2, 3, perhaps 4% of the fund into some European ABS. Also, we can use hedges. Now, since we've launched the fund, we have only ever done one hedge, and that was a Brexit hedge, which I'll talk about a little bit later. So just on the left-hand side, what's unique about this fund? Our first objective is to keep volatility always below 3%. Second objective, to return Euribor plus 2.5% after fees. Just remember, it's long only, there's no leverage, there's no performance fee, we can't short the market, so it's very, very easy to understand, very easy to explain to end clients. You can see where the performances come from. Just an example of how we might move the asset allocation around, depending on where we are in the cycle. Right now, we have the fund positioned in this pie slice, i.e. lower interest rate sensitivity and higher beta. So we have a lot of triple Bs in the fund at the moment. We have a little bit of high yield, but we have duration of only 3.0 years. I'd say the normal duration range for this fund would be 2.5 to 3.5. Right now, we're right in the middle of that at 3.0. If, however, we moved around into this example, which would happen if we had rising inflation and falling growth, so that would be stagflation, then we'd want to lower the beta on the portfolio, we'd sell some of our riskier credit holdings, we'd buy some more floating rate exposures, and we'd take duration down significantly. We think, for example, we are seeing rising inflation globally. Inflation expectations have risen significantly in the last year. If we look in the US, inflation expectations are now 2.4, and the central bank inflation target is 2%. In the UK, we now have, because of Brexit and the weakening of the pound, inflation expectations are now 3.6%, again with a 2% inflation target. So I would argue a lot of the bad news about Brexit has already been priced into the yield curve. One of the things that really differentiates us at 24 is our approach to stock selection. So this chart shows you some of the biggest corporate bond funds in the UK and how many bonds they have in them. If we look on the left-hand side, the biggest UK corporate bond fund, it's over £13 billion, but it has 1,110 bonds in that portfolio. So an average position size of less than 10 basis points. And then you can see the next biggest funds in the UK still have more than 300 bonds in each portfolio, which we think is far too many. The corporate bond fund that I manage is 400 million euros, and we have 85 stocks. We will never have more than 100 bonds in any portfolio that I manage because we have a high conviction stock selection approach. That means we only invest in companies that are our best ideas, companies where we've met the management, we really love the story, and we want to have a proper weighting in the fund. So most of the bonds in our fund are somewhere between 1% and 2% of the overall portfolio. Enough to add value, but enough to be properly diversified and spread risks. One of the systems I use to help me with that is called Observatory. So this is a system we built ourselves. It's a stock-picking database. What it does is takes in the constituents of the Barclays multiverse every single day and then calculates for me their historic volatility. So when I look at any of these bonds, I can compare the yield on the bond versus its volatility to see if I'm being paid properly for just how volatile that bond has been. And not surprisingly, we find when you build portfolios that way, by buying bonds that have a high yield per unit of risk, the return on the portfolio is very good per unit of risk as well. So it's a key part of our stock selection process, this database. The current portfolio, I mentioned before, we really like triple Bs. You can see 2/3 of the fund almost in triple Bs. But remember, these are short-dated triple Bs to keep volatility low, but still give you a very attractive income. We've taken the double B weighting down significantly. We had more than 10% in double Bs prior to the constitutional vote in Italy in December. And we became a little bit concerned that that vote would turn negative and that would be very bad for European banks. So in fact, we de-risked the portfolio significantly. Then, of course, we had the US election. So we've de-risked the portfolio. We've put some of that money into cash. That money is now waiting to be invested, and we think there are some good opportunities coming up in the US market now that President Trump has actually taken office. And as we find out what his policies will be, we'll start putting more money to work in the US market. In terms of sectors, you can see we have less than 1/3 of the fund in financials. The bulk of this is in the insurance sector rather than banking. We think insurance is a better way of having good returns with low volatility because the insurance balance sheets are generally stronger than some of the banks, their earnings profile is a lot less volatile, and they're consistent issuers of debt, whereas banks have been moving away from debt as a form of issuance. We like secured bonds as well, which are bonds that are backed by physical assets. So these could be supermarkets, for example, that use some of their supermarket properties as collateral, or they could be property companies. These are very good, reasonably yielding bonds with very low volatility. The other sector I'd highlight is corporate hybrids. These are non-financial junior subordinated bonds, but you have to be very careful with your name and your issue selection here because there's very good bonds in this sector, but there's also very bad bonds in this sector. So, for example, we don't invest in German utility hybrids. They have very attractive yields, but they have businesses that are deteriorating credit profiles, and therefore their coupons on those bonds are at risk, so we don't invest in them. You can see the overall fund yield, 3.2%, a duration of just 3, so a yield that's higher than the duration, if you think back to that earlier slide. In terms of maturity, not surprisingly, the bulk of the fund is less than 5 years to maturity. We do have a few positions in the 5 to 7 year bucket and 2 bonds in the 7 to 10 year bucket. Because the credit curve is very, very steep, the additional carry and yield you can get from that is very attractive. But we don't like anything beyond 8 years to maturity. Now, on the right-hand side, what might surprise you, given this is a global fund, is how much we have in the UK, especially as you hear all of the commentary about Brexit risks. Well, as I mentioned before, in terms of inflation expectations, I think a lot of the Brexit risk has already been priced in. And actually, in a global context, in investment grade, the UK and the US are where we see the best value. And it's for the following reason. If we look at global credit spreads by currency, you can see the difference between euros, especially in BBB, and dollars and sterling. You get a little bit more in dollars and sterling for the same companies versus euros. But that's for the spread. That doesn't show you the whole picture. That doesn't show you the all-in credit yield. So if we take account of the sovereign curve difference and look at credit yields, you see a very big difference here, especially in BBBs. We're talking about the same companies here. So for example, I could buy a Swiss Re bond in euros, yielding 1%, or I could buy the same company in dollars, yielding 3.5%. And in fact, this chart is quite out of date. You can see the date here is actually November. Given the sell-off we've seen in treasuries and gilts in the last few months, that Swiss Re bond is now yielding more than 4%. So I would much rather own European companies in dollars or in sterling rather than euros because the yield is significantly higher. Now, I don't ever take currency risk in this portfolio, so I must take into account the cost of the currency hedge. But at the moment, the cost of a hedge from dollars or sterling into euros is about 1% a year. So even with the cost of the currency hedge, I still have 2% more yield in exactly the same company buying it in dollars or sterling. So for me, I only have one Eurobond in the portfolio, which is Argenta, a Belgian mortgage bank, yielding more than 4%. The reason being, if I had a portfolio of only Eurobonds, I couldn't achieve the portfolio objective of Euribor plus 2.5%, because Euribor plus 2.5% after fees means a yield of more than 3%. And you can see to get that in euros, I'd have to have credit risk somewhere between double B and single B. And I'm not allowed to have that much in high yield. And it would be far too volatile as well. So that's the reason why the bulk of the fund is in sterling and dollars. We simply couldn't achieve the objective we want if we were in euro investment grade bonds. So the current fund size is actually about 350 million euros as of today. Gross yield of 3.2%. Duration that's lower than that. That's the objective of this fund, to try and always give you a yield that's higher than duration. An average spread of 250 basis points or so over sovereign bonds. BBB plus average credit quality. The themes we're playing are roll down, given how steep the yield curve is, and forward break-evens. That means buying bonds with a low duration and an attractive yield, which gives you lots of protection, even in a rising yield environment, which we think will happen in the US this year. Performance chart again. This is the same chart as before, but now I've also included the largest absolute return credit funds in Europe. And you can see we've comfortably outperformed the competition with a lot less volatility than all of the other competition. So in fact, again, hard to see in the legend, our returns here of 5.73, a standard deviation of 1.52, giving us a Sharpe ratio of 3.28. The next best fund from M&G here, you can see has a volatility of 3.15. That's more than I'm allowed to have. My maximum volatility I'm allowed to have is 3%. Correspondingly, their Sharpe ratio is about half that of ours, 1.7. And the reason for that is if you go back to exactly a year ago, when the market was selling off here in late January and early February, bear in mind, commodities were selling off then, equity markets were selling off, credit markets were selling off. And yes, our fund had a small drawdown. We were down 1% at that point. We're long only, remember. Some of these other funds that can short the market and therefore should be better at protecting capital in the worst times, they were down 4%. So that's where their volatility has come from. In the bad times, they've lost a lot more capital. You might even argue that this fund here remained short the market at the wrong time. Once the market had turned, they kept going down. So this is the problem we have with shorting the market. It's very difficult to do it consistently well because your timing has to be perfect on the way in and the way out. And we think it's impossible for fund managers to consistently do that well. So the paradox is, in the absolute return sector, a long-only fund has smashed the competition in terms of Sharpe ratio or risk-adjusted returns. So this is versus absolute return funds. We also think it's a valid comparison to look at short-dated funds because the bulk of the fund is in short-dated investment grade. And again here, we've beaten the majority of the competition with lower volatility. The one fund that I get personally really annoyed about is this pinkish line here, the salmon pink line. And the reason for that is in February, look what happened. They essentially had no drawdowns. I couldn't understand why a fund that was yielding a similar amount to me would have no credit risk. So when I looked in detail at that fund, their top 10 holdings had 9 of them in unrated bonds. Now, unrated bonds are not members of any corporate bond index. Therefore, they don't have transparent pricing. And if you don't have transparent pricing, you can mark those bonds at whatever price you think is appropriate. So my feeling here is these bonds were not properly marked to market. When everything in credit was selling off, they stayed flat. So I don't think this fund is a proper comparison because of the proportion they have in unrated bonds and therefore illiquid bonds. In euro terms, you can see performance. I should have said these charts are for the sterling share class. We have euro, dollar, and Swiss franc share classes as well. The euro performance, identical in terms of shape, identical in terms of volatility, slightly lower absolute number because of the cost of the currency hedge to euros. Same again for dollars and for Swiss francs. This is the slide I'm most proud of, and this shows our risk-adjusted returns, return per unit of risk. And again, you can see we're significantly higher than other funds with similar volatility, and yet similar returns to funds that have significantly higher volatility. And remember, our threshold is 3% volatility. We're not allowed more volatility than that. So this fund consistently gives you the best risk-adjusted returns. And in terms of weekly returns, you can see this fund gives you no sleepless nights. The average week is +6 or +7 basis points. In fact, we have a slight skew towards more positive outcomes. The one negative week we had was the week of Brexit. So I'll talk about that in the next slide. This is a timeline slide since launch of everything that's happened to the fund. And it's amazing how much has gone on in the market in the last year and a bit. We launched the fund at the end of August, and nothing really happened for the first 3 months. We were up 3% annualized to the point where the Fed raised rates for the first time in nearly 10 years. After that, we saw the commodities sell-off, we saw an equity sell-off, we saw a credit sell-off. We had a small drawdown, but like our backtesting work showed, we would rebound from that very quickly. So in fact, within 1 month, we were back to a new NAV high, and then we pushed on to the date of the Brexit referendum, the EU referendum in the UK. That was on June the 23rd. And you can see the day after Brexit, the fund was down 40 basis points. The actual bond losses were 85 basis points. But we had a Brexit hedge on, and that saved us 45 basis points that day, and then made another 5 basis points over the next week. The hedge we had on was a currency option. We bought a put on the sterling-dollar exchange rate because we thought that was the most effective credit hedge we could have against a market. Remember, before Brexit, all of the polls said Brexit wouldn't happen. So we were very unusual amongst our peers in thinking the risks were high enough that we should hedge that risk. And we looked at lots of ways of hedging. We looked at credit default swaps. We looked at equity options. Ultimately, we thought an FX option was the cheapest and most effective way of hedging. And we did it for all of our portfolios at 24. So that was an efficient hedge. We then pushed on very strongly as QE was priced into the UK market, as base rate cuts were priced in, as the resumption of a corporate bond purchase program came to be. The fund went on to make nearly 6% return in its first year with a volatility of 1.6 and therefore a Sharpe ratio of 3.3. So we're really delighted with first year performance, even in a very volatile backdrop. What are we doing right now? Well, we're looking to take the dollar exposure up, hedged of course. We think dollar investment grade has lots of great opportunities. It also has a lot of risks. We still don't really know what President Trump means for US economic policy. We have a lot of reason to believe he will improve corporate investment and therefore productivity. but he might also increase government spending significantly. That might be inflationary and therefore very bad for the treasury market. So we want to take our time. We've got 2 people in New York now. They'll be picking stocks for us slowly, and over the course of this year I would expect the dollar weighting in the fund to go up. Potentially also add some ABS, floating rate bonds, high quality positions that will give me immunization against rising yields. And also I'd like to buy back some double Bs. I'd like to take the double B weighting back towards 10%, where I can get a lot more yield into the portfolio. I just need to be very careful on the name selection. And lastly, one thing we've also been doing is selling some of our highest quality non-financial bonds, things like AB InBev or British American Tobacco. These bonds are yielding less than 1%, so they really don't deserve to be in the portfolio any longer. Performance, you can see over the 12-month period, sterling is our base currency. We have hedged share classes in these other currencies. The difference between the returns is simply the cost of the currency hedge, but still very attractive returns after fees with a very low volatility, remember, volatility of around 1.5%. So to summarize, volatility is our number 1 objective. We'll always keep that below 3%. Return is the secondary objective, to return Euribor plus 2.5% after fees. 2/3 of the fund is always in short-dated investment-grade bonds to give you very good carry, very good yield with low volatility. But we can do more through stock selection alpha and through asset allocation alpha. We can allocate to ABS, to double B-rated high-yield bonds, and to slightly longer-dated investment-grade bonds as well. It's very easy to understand this fund. It's very easy to explain to end clients, and we think it has a very large capacity. So I think we're going to now go on to Q&A, so we can take questions at that point, I think. Thank you. Thanks, Francesco. Thank you.
Bene. Grazie. Grazie, Francesco.
Well, thank you, Francesco. Thank you, Hervé and Chris. Okay, we have collected a few questions. You have seen the performance of both funds. First question is about performance, and Chris has already mentioned that the global aggregate compared to peers since the launch of the fund in October 2014, and also the absolute return credit since inception has generated a good return. So we collected several questions. I will try to summarize some of them because they are similar. Can you hear me, sir? All right. So questions on the dollar. Questions about the dollar. In particular, they say all other you're short on all other currencies, the sterling and the euro. So what's your view on the dollar and the euro-dollar exchange rate in the short term? What do you think about it? What's your view? Do you think this will have an impact on the high-yield U.S. market? And you have a positive view on the high-yield market in the U.S. Is this due to the fact that you think that shale oil industry will contribute to a positive performance in the high-yield market?
Okay. So maybe the first point on the US dollar. Yeah, compared to our average, we have a very long US dollar position right now. When you analyze currency, and particularly against the euro, at the end, the main factor explaining the euro-dollar exchange rate is the rate differential. So by having the view I described earlier regarding the growth in the US and the more aggressive stance from the Fed, and then much higher yields in US dollar, obviously, it has an effect on the euro dollar. So against the euro, I expect the dollar to perform better. However, the euro is not where I see the strongest move. As I said, I see much stronger move against the sterling and against, for instance, Asian currency. I don't think the euro can go much lower than 1. However, obviously, as I said, you will have a lot of political events in Europe this year, which obviously can weaken the Europe, and then will have a direct effect on the euro. So it's a good hedge against the political risk. Also, the way we express that in the portfolio is also clearly through a very convex position with a lot of out of the money options.
We don't have a long strategic dollar with a non-stop loss.
So also on the US high yield, US high yield is still offers some value. We think that obviously what's going on with Trump is definitely quite positive for US corporates as a whole in terms of spending, fiscal spending, and also in terms of tax cuts. So altogether, we are quite positive on that, and a lot of high yield have also financed quite well. So we don't see any threat, particularly on the high yield, and we think that US high yield should outperform European high yield actually. Maybe on the high yield, do you want to add something on the US high yield?
Absolutely, we totally agree on US high yield. That's why we've hired some US specialists. We think it's a very attractive market, but you need to have people with boots on the ground because you need to meet the companies. And also, we think volatility will be higher. We think President Trump, like him or hate him, will induce a lot more volatility, and therefore you need to be aware of that and manage that in your portfolios.
So we have created the team, actually, both the Zurich platform and the London platform, also by hiring, like now we will have like 4 people in the US to really cover very actively this market.
So we're going to have soon in our in our presentation also the US fixed income team, which is already there.
Un'altra domanda più per Chris.
A question to Chris. The current positioning on BBB bonds in sterling denominated, don't you think this could cause capital losses concerning the impending hard negotiation on Brexit?
It's a very good question. It's a question I get a lot. The first thing is, I think we will have very difficult negotiations with European partners. I think, though, Britain is starting to get its act together. It's very likely we trigger Article 50 by the end of March. I think with President Trump, actually, he might put a lot of pressure on Europeans to get trade deals with Britain done because he's already signalling that he will do a free trade deal with the UK. So I think, no question, we will have a difficult 2 years. But all of that, I think, is already in the price. We have an inflation central bank target of 2%. And yet 5-year inflation forwards are already at 3.6%. So if you think inflation will be higher than 3.6, then fair enough, you don't want to invest in sterling bonds. I still have a lot of confidence that the central bank will get inflation back towards target. So that, for me, makes sterling bonds a really attractive opportunity. Now, of course, there will be a little bit of volatility. There will be a lot of day-to-day news that we need to take account of. But remember, this fund is very short-dated. It's designed to keep volatility lower. I have other funds that I run that invest in much longer-dated credit where volatility will be much more of an issue. But it won't be an issue for this fund because of its short-dated nature.
Un'altra domanda.
One more question about Mr. Trump's likely impact. What kind of impact will he have on emerging market bonds? Could you share any forecasts about also emerging market currencies? Another question about emerging markets. What's the danger posed by the steady decline in Chinese reserves?
So first of all, on emerging markets, the situation and what you observe on emerging market is you have very different situation. Obviously, the impact can be quite big on countries directly like Mexico. You have other countries like Brazil, which are very lowly impacted by what's going to happen in Trump. Obviously, Trump, if he has his plan and if you have a continuous global growth pickup, it will have a big impact on commodities. And a lot of emerging countries are commodity exporters, so it could be also quite positive. The situation, obviously, for Asia is slightly different. What you observe, as I show in Asia, is so on the fundamental, you see actually also a stable growth in China. You saw the last figures, 6.7%, which was quite flat. So we don't see like a big stress on the Chinese economy. What is very worrying, as you said, is like about the outflows and the capital outflows. And that they had to do capital control 2 weeks ago to limit the outflows. Just a little sign is the way the Bitcoin is increasing is only because Chinese try to get out of their currency by selling renminbi and buying Bitcoins, putting like subsidiaries in Hong Kong and so on. So you see a continuous capital outflows. So it will have an impact definitely on the currency. On the trade war with China, actually, it's quite hard to see a full war with China because the two economies are too big and have too much to lose, both of them. So I don't think that the rhetoric from Trump on, for instance, on Mexico can be applied to China. So they will have, and actually there is no big treaty between them. The Trans-Pacific Treaty that he got rid of last week was all the countries except for China because it was done by Obama to actually isolate China. So at the end, it could be not as, from the tariff perspective, it could not be as negative as that for China. But anyway, Chinese economy has been transformed quite a lot as well over the recent years.
Bene. Poi ci sono due domande più...
Two questions that are more commercial in nature, and I'm going to take them personally. But let's see whether there are other questions coming directly from the floor. Maybe you are interested in some, digging deeper into market views or else? Apparently not. Okay, so I have a question for our panelists. Francesco, is it still meaningful? Is it still sensible investing in fixed income nowadays? And also, I'd like to ask the managers, what are their return expectations this year? Well, I'll reply by saying that when I accepted to head the fixed income boutique 5 years ago, we were exactly in the same situation as today. Everybody would say, it's going to be a bloodshed. Why on earth do you want to become the lead portfolio manager in fixed income? And in fact, the very first slide I used in my presentation was titled The Bond Dilemma, the same slide we've seen earlier with the fork in the road. So, I lived this dilemma personally. I talked to professional investors, etc. And the last 5 years were extremely interesting, to say the least, in fixed income. I have a 22 years experience in this business, and I have to admit that every year expectations are proven wrong. So all the beautiful scenarios we paint rarely materialize in practice. So I believe that nowadays the important thing is having a team in place, having a system in place, so as to reduce the risk implicit in investing, which is exactly exactly what we have done via these two funds, by leveraging flexibility on the one hand and leveraging short maturities on the other. This being said, we have lots of specialists, about 20 in Zurich, and we believe that as far as credit is concerned, most likely the year will close at the same level as today. So staying invested in credit, mainly investment grade, but also high yield and emerging market bonds, is something that will help us a lot more than investing in sovereign debt. There might be some volatility to be experienced. Market timing is hard to implement correctly. Investors and managers simply are unable to be perfect there, so it doesn't make sense. You stay invested in fixed income in certain areas, but we know that fixed income is an animal that displays different levels of volatility.
Sure. Should I go first?
Comment for your side.
Okay, so we believe that we've probably seen the bottom in the yield cycle for developed markets. So we think in the US, yields will be rising modestly from here, possibly the same in Europe as well, that at some point Mario Draghi will have to taper his purchases. That will possibly lead to higher spreads and higher yields. And as a result, we think the next few years will be challenging for long-dated bond markets. And what we've done is taken the duration in all of our portfolios pretty much as low as it can go. And we've also tried to give us an attractive yield as we can with that duration constraint. The result of that should be portfolios that return very close to their current yield. So the yield on my fund at the moment is 3.2. My return over the next year should be something like 3.2 plus or minus, let's say, 25 basis points. So perhaps 3%, perhaps 3.5%. That means I can comfortably achieve Euribor plus 2.5% after charges. But it means I'm not going to return 5 or 6% because I don't have enough duration in my fund to make that kind of capital gain. We've positioned all of our funds for a more certain but lower return.
Just maybe to add, so no, just to add up, obviously, what we saw with Chris' fund and our flexible approach is clearly that fixed income is much more than duration, actually, and there are a lot of value to take from different parts of fixed income markets. Also, something to add up on the level of the yields. Yields will go up, as we said, but they cannot go up a lot. That's for sure, because otherwise, there's a problem in the equation. You cannot create a massive fiscal spending with getting a lot of very high interest rate, because obviously the program of Trump and all of the debt, because we have at a very high level of debt worldwide, is not sustainable if you start to have, I would say, 5 or 6% of yield in the US. That means that, yes, we expect yield to rise maybe to 3% on the 10 years, but much more than that is going to be very hard to sustain for different people and actors on the markets. So we expect a rise of yield, but not extreme rise either.
Ci sono domande? Allora concluderei con...
There being no other questions from the floor right now, I'll conclude with two questions that I will answer personally. With a medium to low risk profile portfolio, what are the percentages of the two funds that we should add to? Being a commercial person, being a marketeer, I would say as much as possible. But anyway, nowadays, traditional customers haven't clearly understood that fixed income can also be a source of worries if they invest traditionally when rates go up. So if you delegate completely choices to your manager on how to generate risks and returns, or if you delegate your manager in terms of choosing, the level of return you want to generate. As I was saying, if there are different ways you can delegate managers with different powers and different objectives, but it's important to stay invested in these areas. MiFID II also will modify the way management fees are rebated to advisors, and somebody saying that it will no longer make any sense selling funds or SICAVs products. It's a difficult question. I'd like to say that as an asset manager, we are going to just be subject to MiFID. We will not have an active role, but we have a daily interface with brokers, with advisors, with distributors, and I see that they are kind of revisiting and remodulating their offering. They sell products and services in a different way, and MiFID II can be an opportunity rather than a challenge for them. Looking at what distributors are doing, I believe that MiFID II could be an opportunity for you, an opportunity that can help you leverage your professionality. I believe that your professionalism is the value added you can sell to customers. Thank you very much. I'd like to thank all of our speakers, and please join us at the buffet lunch. Thank you.